Good afternoon and welcome to a truly epic session here, our webinar on how retirees should manage their nest egg. I'm Noam, Professor Emeritus at the Business School and still Director of the Columbia Institute for Tele-Information, a think tank about media communications, internet, digital economy. I used to be in the university Senate and chaired its committees on budget and on benefits, which got me interested in university finances and retiree type benefits. And so I'll be moderating the session, but I'm also going to be kind of be a bit of a lead-in speaker briefly. Now, for retirees, there are many things to worry about. And perhaps the two main financial things to worry about are health coverage and income. On health coverage to retirees, I'd like kind of to say just a quick word. It's not the topic here, but to inform you, I'm happy to report progress. The university, as many of you know, 2 years ago cut the subsidy to retiree medical plans, which used to be substantial and almost all of the medical costs to 20 or 30 years ago. It cut it down to $220 per retirees, and that's per year, and half of that for spouses, which makes about $9 per month for a spouse, which is less than a bottle of Bayer aspirin. I then wrote a report about this and analyzed the numbers and the history and other peer institutions, how atrocious it was. And especially since this could not be argued for being somewhat of a poverty type situation, everybody has to economize, because there was a dedicated, legally separate trust fund, the Columbia University Retirees Medical and Life Insurance Plan, that was sitting there quietly accumulating assets at about $260 million altogether, of which it spent approximately $1 million per year for officer retirement benefits. And officers constitute about 83% of the Columbia employees. And there was, in comparison also to the unionized support staff, which had full coverage, we officers got significantly less. It was so bad that the university kind of mended its way, in fairness, raised it from 220 to the next year 700. That was last year, to this year 900. I'm sorry, 900 this year to 1,500. We're making progress. We're still discussing this. And I'm mentioning this because we might need your help to persuade the university to step up and to match what other universities are doing for their faculty. For example, Harvard, admittedly a flusher institution, has for a couple, a spouse, retiree plus spouse, almost $10,000 in benefits. And NYU has also significantly more than Columbia does. And I'm saying this because we might need your help. Now, the topic for today is the second one, the second financial issue, which is income. How to spend our retirement nest egg and how to manage it. And we have a great panel here, and I will introduce them individually when they step up to speak. We have a team from TIAA. We have a team from Vanguard. Those are the two Columbia Retirement Account Plan administrators. And we have two independent experts, both from the West Coast. Welcome, everybody. And we have a very good audience here. There are 110 people registered. They have an opportunity, all of you, an opportunity to ask questions at the end. Just one word of explanation. Many of the people on this panel are prevented by law from giving you specific investment advice. So don't ask and they won't tell. Let me raise a question to you, and perhaps you can raise your hand. Who here is not retired yet? Is there anybody who's not retired yet? From the hands I don't see, it would show that practically everybody is retired. And my second question is, Who is over 75 years on this call? Over 75 years of this call. That looks to me about at least half. And a third question, who here is with TIAA? TIAA? Okay. And who is with Vanguard? Okay. It looks to me more TIAA, which is not surprising because I believe that at least when I came to Columbia, there was only one option, there was TIAA. Vanguard was added later, so they probably needed it. For this cohort on this call, they probably had more of the older people who were with TIAA and stayed with TIAA. But my rough calculation is if there are 100 people here, and that on average they would have in their retirement accounts approximately, and I'm just guessing here, $1.5 million plus about $500,000 in investment accounts outside of the retirement accounts. Now, this is an optimistic number because according to estimates by the Federal Reserve, only 3.2% of retirees have over $1 million in their retirement accounts. Only 3.2 million have over 1 million in their retirement accounts. But at Columbia, I believe it is better because we had, particularly the older cohorts, a pretty decent contribution plan, defined contribution by Columbia, which was kind of a two-tier system, 10% and 20%. So let's say on average 15% on average salary, that kind of plus your own voluntary contribution. So it's easy for us to have accumulated approximately $30,000 a year, not counting inflation. And you do that for 40 years, that's 1.2 million in contributions. Plus, of course, it grows over time exponentially, so you can easily have doubled and tripled your money. So assuming, therefore, that we have 2 million or so roughly represented here on average, and 100 people, that means that in this call, about $200 million are sitting around the Zoom table. And those $200 million have to be spent, but also invested intelligently. And the questions how to do this is actually, in analytical terms, a difficult question. It's not an easy one at all. So you don't have to feel, just because I'm a retired professor of Celtic poetry, that therefore I don't understand it, because not even the financial experts really have a true, clear sense of this, partly because it is complicated, because it's much more complicated analytically, mathematically, than analyzing savings, because savings, they're bad years, they're good years, but kind of over the long term, it averages out, and you can, but when it comes to dis-saving, there's much less financial literature on this. Dis-saving is more complicated because you cannot just ride out the bear market and wait for the bull market, because in the bear market years, you still have to take money out, which then will not be available to grow in the subsequent years. And furthermore, the long term is not assured for us, unhappily. As John Maynard Keynes said, in the long run, we're all dead. And so for some of us, that's more imminent than for others. And so there's no long term here. And mistakes are more kind of cannot be easily fixed, as well fixed, because there's not enough time to do so. Now I will, so financial retirement and finances are actually kind of complicated to analyze. Now I will address one quick question: how much to spend per year? And then I will pass it on to Bill Bernstein, who will talk to us about how to invest it. How much to spend per year, which is how much do you need? The classic rule of thumb is 80% of your pre-retirement income. And for the spending part, the classic rule of thumb is 4% of your assets at retirement, adjusted annually for inflation. So if you got 2 million in assets, that would be $40,000 per year for over 30 years, minus income taxes, which can be substantial, plus Social Security. And that would add up to less than a typical faculty salary at 65, less than 80% of that faculty salary at 85. So if you want to have $150,000 after taxes before Social Security, you need about $5 million saved. That's if you follow the 4% rule. But there are all kinds of problems with the 4% rule. It assumes a 30-year retirement period, but realistically, faculty retire typically in their early 70s, not all, but many, or later. So 30 years is kind of pretty optimistic. My own mother died recently at the ripe age of 103 years old in pretty good health. So I got, hopefully, knock wood, 25 years left to catch up with that number, and I need to finance those 25 years. So if you give yourself, instead of 30 years, 20 years, you can spend about 6%, not 4% by that same rule. It depends on your risk tolerance. The portfolio can be more aggressive, less aggressive, and it can make you more money, but maybe less money. So the alternatives to that 4% rules are 4% with flexibility, kind of guardrails, 3.5 in bad years, 4.5 in good years, or a fixed percentage of the remaining assets so that each year, whatever you got, you spend, let's say, 6% of that, 8% or 5% of that, whatever savings you had that year. And that number will be declining unless your assets grow faster than that percentage, than the 5, 6 or so percent. My favorite is, and that's my last thing here, is that to spend according to the R&D. I believe that virtually everybody on this call is familiar, unhappily, with RMDs. It's kind of what you must take each year after age 72 if you're not employed by the same plan, that is Columbia. You must take the RMD, which is calculated based on your life expectancy as a divisor from the assets that you have accumulated, and so that would be, so if you take the same percentage and apply to all your assets, not just to your retirement assets, then you could kind of follow that spending. Your spending rule would follow that particular percentage, which is at the age of 72, approximately 3.6, 3.7%. So it's close to 4%. It's growing as you grow older, and you don't have to take all of it. That is, you have to take the RMD from the retiree for retirement account, but you don't have to take it from your non-retirement account. So you can spend less and make your heirs happy. Okay, and now, so these are my observations on how much you can spend. And you will find that for many people, this clearly has meant a reduction in the standard of living. Now, but when it comes to the second basic question, how do we prevent a reduction in our standard of living, has to do with how we invest the money. You have already invested it in a variety of ways over your active time period of employment. But now the question is what to do and what to do differently when it comes to the retirement funds that you have, the nest eggs, which includes the tax deferred, but also the after-tax type accounts that you might have with companies like Schwab, et cetera. And to address this question, we have as a guest here, Bill Bernstein, who will speak to us from Oregon. What is remarkable about Bill is that he is not just a boring financial economist, but he is actually a polymath of sorts. He is a Ph.D. in chemistry, and that's one of the reasons why I like to have him here, is because he has his foot in multiple camps. He is a Ph.D. in chemistry. He is a medical doctor, and he has been a neurologist for many years. And so one day he must have had, as a neurologist, some something going through his brain about becoming an investment advisor, analyst and advisor. And he's written many books on the subject. The Intelligent Asset Allocator, or another book, The Four Pillars of Investing, Lessons for Building a Winning Portfolio. Then he has introduced something called the Coward's Portfolio, which kind of he will possibly explain. And one of the things that he is advocating, and I'm kind of in his camp, is not to worry about the individual stock, but to invest in broad asset categories like stocks and bonds and international, et cetera, et cetera. And he will now speak to us, and we can extremely happy that he could give us his time. Thank you very much. Go ahead, Bill.
Okay, well, thanks for that kind introduction. I hope I don't drop off the call. It's already happened to me once. So if that happens, Ellie, just move on to the next speaker and I'll come in later. Thanks for that kind introduction. I love your remark about the fact, remarking on the fact that even experts really have a hard time modeling the problem. And the reason for that is simple, which is that finance is not an airfoil. It's not an electrical circuit. And unfortunately, finance attracts people who are really good at math, who think that it's the be all and the end all, and these people frequently wind up shipwrecked on the rocks of human history and fall subject to the whims of the cruel mistress of human history. It's a very inexact science. What I'd like to do today is to frame what follows, the next three speakers, in terms of what's called very loosely and informally life cycle theory, which is basically the idea that not only do you have your investments, but you also have human capital, which is your future stream of earnings, which is more relevant if you're young. And I don't want to talk about young people too much, but it does introduce the subject, which is that a young person has a massive amount of human capital, millions of dollars of future earnings ahead of them, but they may only have at an age 25 or 30 or 35, a 5 or a 6 figure 401k or IRA. And so that person, even if they invest 100% of their investable assets in stocks, only has a 3 or a 5 or a 10% stock allocation compared to their total capital. So the young person, it's impossible to invest too much of their investment capital in stocks, at least if they're emotionally able to do that. And the problem is that as you get older, that proportion of investable capital goes up, your human capital goes down, until by the time you're retired, you have no more human capital left. And the problem with that is that your human capital, which is basically a bond, especially if you have a nice, safe profession, like you work as a letter carrier, or if you're a tenured professor at a wealthy university, your human capital is a bond, and it has a flow of income, and that should precisely match your liabilities, that is your living expenses. So it's like you're paying a giant mortgage every year. It's not just your actual mortgage, it's all of your living expenses that you have to pay month after month and year after year. And the good news when you're young is that your human capital should match that pretty well. The problem is that as you get older, your investment capital, which is all you have left, may not match that. And that's what personal finance at base is all about. It's about matching your investment capital with your living expenses, with your liabilities. And so to the extent that when you're retired, your investment capital looks like a bond or is mostly bonds, you're in relatively good shape. But if you go into retirement and too much of your capital or almost all of your capital is in stocks, then you are taking an enormous amount of risk because stocks are a very poor match in terms of liability matching your assets and your liabilities. If you start out in retirement and you have a bad sequence of stock returns early on, you may run out of money very, very quickly. Now, it is true, even in retirement, that stocks have a higher expected return than bonds. But that is the same as saying that 5 out of 6 times when you play Russian roulette, you're going to do just fine and have a positive return. All right. The name of the game in retirement is not to have as much money as possible. It's to avoid dying poor. Those of you, who have a good grounding in philosophy would recognize this as a classic Pascal's wager, which Russian roulette is an extreme form of. It's about asymmetric consequences. If you invest too much in bonds and not enough in stocks, and stocks do really well, you don't get to fly first class, and you don't drive a BMW. But on the other hand, if you invest too much in stocks, and that's the wrong decision, the consequences can be much, much more severe. So how important is this business of matching assets and liabilities in retirement? Well, Ellie has already alluded to that, which is what's your burn rate? Okay, so let's take the extreme and rather felicitous case of someone whose pension and whose Social Security completely covers their living expense. Well, that person's investment portfolio is almost irrelevant to them personally because that's not their money. Okay, if your living expenses are met by your Social Security and a fixed pension, then you don't need your investment capital. That belongs to your kids. It belongs to whoever else your heirs are. It belongs to your charities. If you've not done your tax planning, it goes to Uncle Sam, or maybe you're patriotic and you don't mind paying it to Uncle Sam after you're dead. So that's an extreme case. Now, at the other extreme is the person who just doesn't need 4%, as Ellie suggests, but who needs 10%. All right. And that person we're not going to deal with today because that person is in a world of hurt. And that person faces some very, very bad choices. They have to work longer, they have to crimp their style of living, or they're going to have a very high risk of eating Alpo in retirement. So what I think will follow from the other speakers and presumably your questions will be, what does the person in the middle do? What is the person, for example, who has a burn rate of 5 or 6% to do? If that person is 80 years old, they're probably in good shape. If that person is 60 years old, they may very well have a problem, and they should pay attention to having their investment assets match their liabilities. And the next speaker, Ed McQuarrie, is going to talk about the precise vehicles that do that.
Thank you very much, Bill. I will introduce now Ed McQuarrie, who is a social psychologist from the University of Cincinnati, a Ph.D., was a professor emeritus in the Levy School of Business at Santa Clara University in Silicon Valley. And he's been publishing in marketing and advertising, in market research, in consumer behavior. And that got him to also to discuss and analyze and speak to us about financial strategies. So please go ahead, Ed.
The answer is the one thing TIAA can do for you that Vanguard cannot is to annuitize some large fraction of your account. And when you annuitize, you take a very large sum of money, you hand it over to the insurance company. They guarantee you to send money back for your life or joint lives, typically with a 10-year guarantee. Should you annuitize? That is the question for the 100-some Columbia retirees who are on the call. Well, I cannot answer that question. I'm not a financial planner. I'm a guy who spends all day thinking about these topics and then writes papers about what I've learned. So what I'm going to do today is I'm going to explain to you why I am going to annuitize a very large chunk of TIAA traditional. But before I get started on that, and this is a point I will emphasize several times, you do not have to annuitize. As Ellie mentioned, you will not run out of money taking RMDs. Now, this chart style is going to be used throughout. Let me walk you through the first one. On the vertical axis, we have income from required minimum distributions. If you have $1 million in TIAA traditional, I assume that we all do. If you have $1 million in TIAA traditional, and depending on your birth date, by the time you get to 73, you will be required by the government to withdraw $37,700 from your TIAA accumulation. And so we see that over on the left here. Now, that RMD schedule is keyed to our mortality table. The Congress really hates it when you try to pass on a large sum of tax-sheltered money to your heirs. They make you take it out, and they make you take out more and more. So you can reasonably expect on a TIAA accumulation earning perhaps 4.5% throughout, that your income from that $1 million through RMDs is going to start at $37,700. It will approximately double by your mid-90s, and it will not fall below the starting level in nominal terms until about age 106. So you don't have to annuitize. This is what you can reasonably expect if you do nothing. Okay. But if you're not going to annuitize, it's really rather silly to leave $1 million in a completely safe vehicle like TIAA traditional. The safer your investment, the less you can expect to earn. If you're willing to take just a little bit more risk, you could put the money into Vanguard's Retirement Income Fund. That is the destination for all of Vanguard's target date life cycle funds. You hold it for life after about age 72 or 73. It's essentially a 30% stock, 70% fixed income portfolio. You can reasonably expect to earn 6% over the long term on such a portfolio. You will see that that means your hump is higher, the peak is later, and you might reasonably expect as you get to the upper 90s to have almost triple the RMD that with which you started. But that's not guaranteed, as we may see later. Okay, well, you say, I got plenty of money. I don't need to take any risk. I don't need that Vanguard Retirement Income Fund. Well, here's an argument for why, indeed, you might need such a thing. Basically, the green line here is historical inflation at 3% roughly since 1926. You can see that on a nice conservative safe investment like TIAA traditional, your RMDs will keep you above the inflation line if inflation is well behaved until your mid-90s. But a slightly better performing asset would have kept you above the inflation adjusted value of your first payment through perhaps 103, at which point you're safe, and all too traditional investment is basically suffered a 33% shortfall in terms of real income. Not so good. All right then, so much for the RMD path. That's all you have to do. The government makes you do that. The annuity path looks very different. I'll assume a 73-year-old couple, joint life expectancy about 21 years, 10-year guarantee, 4.5% crediting rate. If you're older than 73, they pay you more. If you're single, they pay you more. Okay, if interest rates go up, the payout might be better. But these are plausible starting points. And take a look at how the chart has changed here. You will start out with that annuity payment at those assumptions at about $74,000, not $37,700. So you're going to match the peak to be expected from your perfectly safe TIAA traditional asset all the way through that peak. And then you're going to stay there until, well, rounded to the nearest 0.25%. At age 110, both of you are 100% dead. Okay. But if you happen to be alive, you'll still get the payment. Now, notice how that you don't fall quite so far behind inflation when you start up this high. Now, if you wanted to inflate the 74,000, that of course would be a different thing. So this is the first thing that attracts me personally to annuitizing my totally safe TIAA traditional. And just to concentrate your mind though a little bit, whenever I show this annuity chart, I always follow up with this annuity chart. One day after the 10-year guarantee period ends, You and your spouse, leaving that fine restaurant, are wiped out by a drunk driver. Your annuity income drops to zero. There's nothing left in the account. You gave it all to TIAA in the beginning. And how should we say? This chart will never appear in a sales pitch. But wait, there's more. If you've held TIAA traditional for a long time, you will have a TIAA loyalty bonus, which can be quite substantial. And basically what they do is they release reserves and they augment your payout. Could be 100 basis points. I have one such account. Could even be 200 basis points. I have another such account. Okay. And that looks like this in our long running chart. You might start off not with 74,000, but 84,000 a year, or even 94,000 a year. And now you don't fall behind the inflated RMD if inflation is well behaved until about age 103. And in a nutshell, this chart explains why I plan to annuitize my TIAA traditional balance starting next year. I want the money. So we come, I'm almost done, Ellie. We come to the true purpose of the life annuity. In my mind, it's not to protect against longevity risk. RMDs will do that. Rather, it's to help me live large while I'm still young enough to enjoy it. Now, that's all we have time for in terms of my presentation. If you're interested in the question and answer session, I've prepared some additional slides. I can talk to you about Secure 2.0 and partial annuitization. I can show you the actual rather than the idealized return on Vanguard retirement income. For grins, we can look at what RMDs on a 100% stock portfolio would look like if you retired in August 1929. We can talk about a TIPS hedge for the life annuity, and I have a great little picture on mortality curves.
I kind of doubt that anybody here has retired in 1929.
It's a sort of thought starter.
So we talked about TIAA and we talked about Vanguard, and now we'll give them a chance also to speak to us. So first, the team from TIAA, Angela Bellamy, she is the Director of Financial Planning. She is not only been with TIAA for how many years now? Looks like 10 years or so, but she was also before that at Vanguard itself. So she's been kind of like on both sides of this divide here. And she comes to us with background education from the University of North Carolina, and with also, I found, in addition to the financial certifications that you have, Angela, also an accredited domestic partnership advisor, something that's kind of sounds really interesting. And with her is Vito Ruvulo, Senior Director, Relationship Management at TIAA from St. John's University, and subsequently he has been at TIAA for 33 years, and he's relationship manager, which means he's the point person with Columbia University, I believe. And so we're very glad to have both of you here, Angela and Vito. Please go ahead.
Thank you so much, Ellie. I really appreciate it. And thank you everyone for joining us today. So I guess the best place for me to sort of jump in here is that we're going to be covering, or probably more of a recap, because thank you so much to William and Ed, prime the pump a little bit for me here. Really, you're covering a topic today that is at the very heart of what drives us here at TIAA. We want to get you not only to, but through retirement. And for those of you who have already retired or you're semi-retired, congratulations. And I hope that you're enjoying the transition, that this conversation is not doing a groundswell for a little stress for you. Hopefully we can squelch a lot of that. For those of you who are still working, hats off. Joining this conversation will help you even better prepare to retire. So as I thought about speaking with you today, I wanted to make sure that I gave you, even on the heels of those great, comments from both William and Ed, maybe a bit of a recap of TIAA traditional and the loyalty bonus, some of the challenges that we see retirees facing, and how having a diversified income plan can help to address some of those challenges. So a little bit similar vantage point in a lot of places, and a little bit of additional sprinkles, if you will, on the conversation as well. And of course, Mike with Vanguard will come in with some additional details as well. So we don't want to steal each other's thunder here for the conversation. So let me share a little background on TIAA traditional before we dive any further into those challenges. For those of you who have TIAA traditional annuities as part of your portfolio, or you're considering it, you should know that it's really unlike any other retirement product. And again, Ed did a great job of teeing that up. This is because while you're saving, it's protecting your contributions, and it offers a guaranteed rate of growth, and it isn't tied to market fluctuation. So that when you retire, you can provide income for life and not run out of money. So we touched a little bit on what annuitization is, but just to give you, again, a bit of a recap there, annuitization is turning that investment annuity into an income stream. So at TIAA, we often say, want to activate that retirement check for you, because you're going to annuitize and start receiving monthly income for life. And then the loyalty bonus that Ed teed up for me is really what we see as, for our long-term contributors to TIAA traditional, you're contributing to this plan, you make it possible to be able to do what we do. And we want to have the opportunity to potentially have you receive additional amounts. And that's the loyalty bonus, and that's for higher income payments going forward. So how do we do this? That's actually based on the TIAA charter. It requires us to serve our core clients without profit. So that means participants like yourselves, you can receive growth and income above and beyond the guarantees that are already in place. So that means that we're sharing the profits. It's really our approach and the opportunity for us to see more growth and income in those guaranteed amounts above and beyond what you're used to. The longer you've contributed to a TIAA traditional account, the bigger your loyalty bonus may be when it comes time to turn your savings into monthly income. In the last decade, long-term contributors to TIAA traditional received higher lifetime income at the time of retirement than those who transferred just shortly before retirement. So having traditional in your portfolio longer, you participate in those loyalty bonuses for a longer period of time. So while those amounts are definitely not guaranteed, we can't hang our hats on those as being a must that you'll receive it. It is something that we can state pretty firmly that TI traditional has paid more than the guaranteed income, minimum income, every year since 1949. So we are pretty proud of the ability to pay not only the minimum guaranteed amount, but also more than that with those loyalty bonuses. So that's quite a bit of money being shared back with those who have invested for the long term in that TI traditional account. Now, even if you don't expect to retire for a while, talking to a TIAA professional consultant about income is something that you can get your hands around sooner rather than later. And if you are already retired, you can do that, have that conversation as well. And that conversation would include a discussion on loyalty bonuses to help you make the best decision possible for you, given your savings, where you stand, what your income needs are. And there's no additional charge for that conversation. So definitely take advantage if it's something that's on the tip of your tongue, or kind of burning a hole in your pocket. You have an opportunity to take care of that. But we're always here to give you a hand with that type of conversation. Generally speaking, a lot of folks wonder, well, who's eligible for this loyalty bonus? Generally speaking, you would need to contribute to TIAA traditional for about 5 years of continuous participation or more to start to see those loyalty bonuses. So again, all is not lost for those who may have not contributed into it for very long. Generally 5 years or more of continuous participation, you'll start to see those loyalty bonuses.
Angela, since you're, sorry to interrupt, but since you're kind of essentially kind of touting here a particular investment product, then I have to ask you a question, which is important, namely, because it is not being provided. You don't have to provide it by law, but other companies do, which is what is the expense ratio? What is the fees that go into this particular investment vehicle? Because we all know that there are some low-cost type vehicles around, and we simply cannot judge how that works with the traditional. And the second question then is, what about the liquidity, which is, as far as I know, kind of particularly the university-supported plans, you need 10 years, approximately 10 years, in order to liquidate that amount. So this needs to be discussed too, right?
Absolutely. Great questions, Ellie, and definitely ones we want to share here with the audience. So I'll grab that expense ratio here while the next person is speaking, and I'll get that for you before we wrap up the call. But in terms of liquidity, we actually have 2 versions of our TIAA traditional, an illiquid version and a liquid version. And obviously the liquid one is the one you can move in and out of more freely. And the illiquid, to your point, Ellie, does require a certain amount of time that you hold that. Generally, you'll have to dispense of it over a 10-year period if you're trying to sell out of it. So it's done gradually to de-invest or to take money out of that account. So it is definitely meant for stability for a portfolio. So that's where we want to have that conversation about risk reward, about goals, to make sure that it is the right fit for your portfolio in any portion, in any amount in the account. But thank you so much for bringing that up. We do have both illiquid and liquid.
And I could grab the expense. So Ellie, much like a bank account, I mean, the interest rate posted is the interest rate given. There's no hidden expense or expense ratio that is deducted from that return. So what you see when we post is what you get.
Do you have the current rate, Vito?
Don't have that handy.
Okay, no worries. We'll grab that for you before we wrap.
Angela, you're going to have trouble locating that because, as Vito said, essentially there is no expense ratio to TIAA traditional.
Right.
TIAA has expenses, of course, but it's just not at all parallel to a mutual fund expense ratio.
It's not. So we tend to give you a rough idea of what our expenses are for the year. So it's not quite apples to apples in that respect. But again, that's why we're unique, and that's why it's a unique investment. So absolutely. Thank you. All right, had a couple more things I wanted to touch on here, and those were the challenges. So we talked a bit about TIAA traditional and the loyalty bonus, but also too with the retirement plans, the things I want you to be concerned about, and a little bit of this has been covered already, but longevity, definitely the idea that if you're a part of a couple, generally at least one partner in that couple will make it to age 65, or at age 65 will make it to age 95. So longevity is very much a concern. So making sure that you don't outlive your assets. The next item is market risk or volatility. So a lot of that sequencing of return risk, that's the idea that you may have to make withdrawals when the market is volatile. So that might cause or impose a bigger drop to your portfolio balance than you would like over time. The next one is cognitive. 1/3 of Americans age 65 or older may have some mild cognitive impairment or dementia. So making sure that you are trying to ward against that by either having a trusted partner, a loved one, someone who can operate on your behalf, a power of attorney, someone that may be able to step in if you see that type of decline happening. And then also inflation. So of course, the idea of eroding the purchasing power of your dollar over time. So a lot of concerns there, and those can be addressed with diversified income or having a diversified income strategy. And what we like to get into from a diversified income strategy is this idea that systematic withdrawals or periodic ones that you may take out of the portfolio with your own rhyme or reason. It might be subject to obviously inflation or liquidity and things like that. But the more you have a strategy in place, the easier it is to mitigate some of those retirement risks like longevity, market risk, cognitive risk, and inflation. So definitely keep your eyes on those things. And in terms of how we would say to spend from your portfolio, we like a 2/3 point of view. That's 2/3 of your retirement income coming from lifetime income sources, and the other third coming from the portfolio, whether that be additional withdrawals as needed from what you're trying to spend. So that's Social Security, defined benefits, fixed income, those types of things giving you a leg up. Traditional portfolio stocks and bonds will be a way as well. And then, of course, lifetime income sources. So between Social Security, defined benefits or pensions, fixed income, or lifetime income options, those will be the 2/3. And then 1/3 will be from your portfolio of stocks and bonds. Having that mix would give you an increased income efficiency, mitigate retirement risk. It'll help you create some liquidity as you need it, gives you flexibility as you move forward, and it allows you the potential to leave a larger legacy as well. So a lot of great options there, but I'll move on to Mike with one comment before I do, and that is some key takeaways, like I mentioned here, is that consider how TI traditional, which has been mentioned a few times, it may or may not complement your investment portfolio. So definitely take a look to see if it's right for you before investing in it. Understand the challenges that are facing retirees. Again, that's longevity, market risk, cognitive risk, inflation, those types of things. And more than anything, for you, give some thought to how a diversified income strategy might help you reduce your risk as you move forward.
Thank you. Thank you very much, Michael and Vito, and Ed, who also added to this. Our next team is the one from Vanguard, headed by Michael Palazzi, who is the senior investment strategist. Sounds impressive. For defined contributions, the payments that Columbia is making into the accounts at Vanguard. And he is responsible for conducting investment reviews for institutional, intermediary clients, as well as ultra high net worth clients, which we, of course, hope that he will make us into. He has degrees from Rider University in finance and global business. With him is William Monroe, a relationship manager at Vanguard with education in Penn State, has been at Vanguard a relationship manager for 10 years. And I assume, therefore, that he has been for many years also a relationship manager with Columbia University. So we welcome both of you.
Well, thank you so much, Ellie. I'll jump in there. And again, just thank you so much to you and the team for organizing this fantastic event. It's been great to hear from the other panelists for today's session as well. And I think in the next 5 to 10 minutes, I'm going to take a bit of a different approach. I'm not here to talk about any single investment product, although certainly if there are questions during the Q&A, happy to address them from the Vanguard end. But obviously, the goal of this session is to discuss spending and asset allocation for those nearing and living in retirement. And obviously, as has been touched on, 5 to 10 minutes clearly can't do this topic justice. So I really want to focus our attention on 3 key areas as you sort of consider entering and living in retirement. And what this framework I'm going to talk about today is really based on a research paper that my colleagues at Vanguard authored back in 2023 titled From Assets to Income, a Guide to Retirement Income. So the first of these areas I want to focus on today is to focus on developing a prudent and durable spending strategy. It'll touch on some of the themes that some of our other speakers have touched on today. The second piece of my prepared remarks is really going to be considerations for investors around building soundly constructed investment portfolios in retirement. And that can take a number of different approaches, but we're going to talk about more of what I would characterize as a total return kind of approach that we think can serve investors very well. And then lastly, and we'll touch on it very briefly because I admit I'm no tax professional, but important for investors in retirement is considering tax efficient withdrawal strategies. And Ellie mentioned at the onset, obviously many in the audience have saved prudently and well within their retirement plans, but also might have savings outside of their retirement programs. So working with a qualified tax professional to ensure tax efficient withdrawal strategies is really a critically important element of portfolio survivability for investors over the long term. I would fully acknowledge as well, all of these components of spending down the assets you've accumulated involve a lot of complexities, and each one involves trade-offs as well. So there is no truly one-size-fits-all solution, but I am hopeful that this framework will make navigating these complexities a bit easier for all those in the audience today. So starting with the first area of focus on developing a prudent and durable spending strategy, that really has 2 components. One, the first, which is rather simple, but oftentimes can be overlooked as investors close in on retirement. Often they're thinking about how much can I generate from the assets I've accumulated safely. But really this exercise should start with the other side of the coin, thinking about a more simple budgeting exercise, right? And this is not just for those nearing retirement, but certainly needs to be reevaluated for those living in retirement as their expenses will and do change over time. So importantly, this is looking at sources of both income and your expenses in retirement. The sources of income, Angela mentioned this, may be fairly straightforward. This could come in the form of Social Security or any pension benefits. And these are sources, good news for investors, that are likely very stable and enduring sources over their retirement years. It's also important on the other side to make an estimate of expenses. And I think most important, it's worth evaluating what are required expenses versus the discretionary expenses in retirement. When we think about required expenses, food, shelter, medicine, utility bills, as an example, all the things that we certainly need to pay in our retirement. And then the discretionary side is the things we would like to enjoy in retirement, hobbies, travel, other philanthropic endeavors, as an example of that. Ultimately, the gap between income and expenses ultimately is what's needed to be supplemented from an investor's portfolio. And after that's accomplished, the investor can start to look at different spending strategies to meet that need. And Ed brought up a good question that, again, I can't answer for everybody in the audience, but how much or should you annuitize? And maybe one way that investors can think through that, to the extent there's a gap between their fixed sources of income and what those required expenses are, they may think about filling that gap potentially with the more guaranteed sources of income that Angela and Ed outlined. So again, one way to sort of think about that annuitization puzzle, again, no one size fits all feature for everybody there. When we think about 4 factors that are really going to impact your portfolio withdrawal rates, one would be your time horizon. To the extent your time horizon, which is uncertain for most of us, but we think about 30 to 35 years of retirement time horizon, to the extent your time horizon is longer, that might require you to spend less from your portfolio over time. The other element and sort of lever that'll impact this is asset allocation, right? We're going to talk more about that asset allocation picture next. The third part would be spending flexibility, right? And this is where we get to that discretionary bucket of spending. Maybe we as investors can accept a trade-off and some flexibility in our annual spending, particularly for those non-required or discretionary expenses in our retirement. And inevitably, those discretionary expenses are going to change as we age over time as well. And then the last part would be the degree of certainty you as an investor desire. So many on the call today, and Ellie mentioned it before, have sort of heard about some rule of thumb approaches like the 4% rule he referenced. And when you think about different spending strategies, it's important to understand how these different strategies might impact income and spending volatility for you in your retirement. Ellie mentioned the dollar plus inflation approach, which is essentially selecting amount at retirement and adjusting that by inflation year over year. And this certainly will provide an investor a lot of stability in their expected income. But the reality is this could lead to quicker portfolio depletion, particularly depending on the market environments, not just those that occur right after retirement, but certainly over the fullness of your retirement as well. So again, that trade-off between the potential for depleting your portfolio with a more stable approach, the dollar plus inflation. The other one Ellie mentioned, which is out there, is this percent of portfolio rule, right? Which is taking a year-end balance at your portfolio and spending, say, 3, 4, or 5%. Now, the challenge here would be this can lead to significant volatility in what you're receiving from your portfolio, given the market conditions, good or bad or indifferent, depending on how the markets perform. But in theory, an investor would never deplete their portfolio over time if they're only taking a set percentage of that portfolio, recognizing that percentage and that dollar amount could get lower and lower over time. So we try to strike a balance when we think about optimal spending strategies. And in general, Vanguard really advocates for what it calls a dynamic spending strategy. And really what that entails is setting both a ceiling and a floor around a more fixed number each and every year. And again, this will require some investors to accept a trade-off and variability around their income generated from their portfolio. But the simple theory here would be that when markets are good, it would allow investors to take a bit more, harvest, if you will, some of those gains. Take the last 10 years for equity investors as a great example, might allow you to expend a little more up to a certain ceiling naturally. We wouldn't want that to get out of hand. And then on the opposite side of that, setting a floor, right? Making sure that we have a minimum that we can spend from our portfolio. That will, again, require that trade-off of spending less in some of those leaner market years. But when we look at the outcomes associated with that dynamic spending strategy, if you're willing to accept some variability in spending, the portfolio survivability over a 35-year time horizon is still quite strong for investors. Now, after you as individuals sort of think through the budget, right, the discretionary versus required expenses, the spending strategy that you want to employ for durability of that portfolio over time, it's also important to think through asset allocation. And that's something we haven't talked significant about during the call, but I didn't want to leave it shortchanged because it is a very important decision for investors in their retirement. And again, Vanguard, generally speaking, advocates for what we would call, and the industry would call, a total return approach to investing. And simply put, a total return approach to asset allocation really seeks to maximize returns per unit of risk. So a portfolio in academic terms that sits on the efficient frontier. And this is generally speaking, building a portfolio of stocks, bonds, and cash that provides adequate return to you over a long-term time horizon based on your comfort level with risk, which is often measured crudely, frankly, by volatility. Oftentimes, investors that we talk to, particularly those entering retirement and living in retirement, feel the pressure and the need to change their asset allocation. A common example of that outside of guaranteed income that's been talked about is tilting towards more income-oriented investments in retirements, because naturally you're in need of income. So it stands to reason that you might think about your portfolio in this income orientation. What does that practically mean? That might mean tilting towards, in your stock portfolio, hypothetically dividend-oriented equities as an example. In your fixed income allocation, that would be tilting towards higher yielding, I would say more credit-focused sectors of the bond markets. And again, we caution investors to think through the trade-offs of that decision, even though it can be a rather intuitive one for many investors, because it can lead to some rather unintuitive results, unfortunately. for investors. By tilting towards those segments, you may in fact be actually reducing diversification when it can matter most for you in retirement. As an example, if we tilt our portfolios towards dividend stocks, it's more likely that we're going to be concentrated in certain sectors and industries that have historically paid higher dividend yields to investors. So to the extent those sectors underperform the market, obviously there's a give up in that. Again, if we take the past 10 years as an example, certainly those kind of strategies have not fared as well as the broad market. Now, the other side of that, when the market is challenged, you do tend to see stocks like that, I would say, hold up better and provide some downside protection. But again, long-term total return approach would focus on a broad market cap weighted exposure across both US and non-US equity markets. This could also have a detrimental impact on long-term portfolio returns, which I've talked about. That growth of your portfolio, even in retirement, is critical to maintaining your portfolio and allowing that income to accrue to you over many years of retirement. The other challenge with an income-oriented approach is we've seen this, right? Yields and income do change over time. So if the goal is just to send the income generated, right, to your checking account or savings account, this can also lead to volatility in the size and timing of your cash flows in retirement that you want to be mindful of. The other part of this is tax efficiency, right? Depending on asset location, so where you are employing these asset allocation strategies, this can lead to different tax situations. If they're spinning off a lot of income in taxable accounts, naturally you're going to receive a 1099 for those kind of distributions and just want to be considerate of that. So we talked about developing a prudent and durable spending strategy. We talked about asset allocation from a total return relative to an income-oriented perspective. The last piece I want to touch on very briefly with the last minute or two left is tax-efficient withdrawal strategies. And this is something that is at times overlooked, but extremely important, of value added, right, for investors. And I do not want to represent myself as a tax professional in any way. But to the extent you as an investor have different buckets of savings, including both taxable and tax deferred monies, it is very much worth considering where you are drawing from first, how your assets are located and your asset allocation are located amongst those accounts, and then think through the impact of legacy planning efforts and the potential impact here as well. So I'll just close by saying that covers a lot of ground in a very short period at a high level, but I'm hoping this three-part framework can really help you inform your decision-making in retirement. Even in retirement, your situation can and will change meaningfully over the years. So it's always worth revisiting these plans every so often. And as I mentioned, all decisions involve complexities and trade-offs.
Well, thank you. Thank you very much, Michael. We are now 1 hour into our session, and we have time for questions. To break the ice, I'm going to ask a first question maybe to Bill Bernstein. It's about the portfolio, the asset allocations, and the typical rule here that we've heard, probably all of us, was this 60-40 rule of thumb: 60% in equity, 40% in bonds, fixed income. That percentage would change from 80% maybe when you're young to 20% when you're in the retirement age, and that is in fact institutionalized in these time-defined funds. TDFs that companies such as Vanguard, but practically everybody offers, which gives you the 60-40 and the 20-40, 20-80 or whatever over time as you kind of grow older, get to your retirement and beyond your retirement. And the question is really whether these allocations make real sense, or whether, in fact, as an investment strategy, considering that you also have other assets that are outside of that fund. And by the way, these funds, just so that we understand, people sometimes imagine there are all these little Warren Buffetts there in the back room trying to analyze what to invest in. They're kind of totally dumb type investment vehicles in which you get, let's say, Vanguard time-defined funds would have 5 or 6 or 7 of its own index funds. So they would have domestic and international and bonds and stocks and so on. So they would have five, and they would five of these funds that would just kind of change their allocations every few years, almost automatically, and therefore they would charge you, in effect, implicitly twice the expense fees, once for the fund itself and once for the funds that are in the fund again. So you're basically paying, it's like in a restaurant that you're paying for in prix more than for the identical dishes on an a la carte. And usually it's the other way around. And so it in that sense, it makes no sense really to me, except that it's kind of like convenient and easy for the lazy investor. But you pay money for it, and it's not, you're never being told how much actually it costs you extra to do a kind of 1 or 2 or 3 trades every 5 years. How complicated can that be? And would you spend literally hundreds and thousands of dollars for avoiding that particular chore? And so my question to you, Bill, is you have done that Coward's portfolio for asset categories. Can you possibly speak to us about how it would apply, and therefore what you would recommend for a typical, I know it's very difficult to have a typical professor, but for a typical retired professor, how would that look like in your view?
Well, the Coward's portfolio is something that I came up with, I think, 30 years ago, and my thinking has evolved since then. But it basically consists of 8 different equity asset classes, and then one big bond fund. And it's a lot of work. You have to have a spreadsheet. You have to be rebalancing it. You have to be looking at it at least once or twice a year and doing the appropriate transactions. And what I've learned over the past 3 decades is that that's just too much work for most people, and it also requires too much emotional discipline to be rebalancing back into the things that have done lousy and selling the things that have done well. I have a different point of view about target date funds. As you point out, they are far from perfect. But in this particular case, the perfect is the enemy of the good. And for the average person, your typical low-cost target date fund, especially one from Vanguard or from BlackRock, or one of the low-cost ones from Fidelity, not the ones that are high cost. They have 2 different classes of them, and you have to figure out which is which is not easy. That is going to be good. That is going to be a fine investment, even in retirement, for 95% of investors. And that's what I recommend to most people. It is true, Ellie, as you point out, that you can actually put together one of the Vanguard target date funds on your own for maybe 5 basis points less per year. For most people, that is just not worth the trouble and the hassle and the demands on your emotional energy. If you're the kind of person who loves doing that and it's fun and you can actually rebalance into the poorly performing asset classes when it looks like the world is ending, then God bless, go do it. But for most people, a target date fund is good enough.
And Ellie, can I provide one point of clarification? You mentioned sort of the cost associated with it. When you look at the Vanguard target retirement funds, right, they are that expense ratio that individuals see. That is representative of the weighted average of the underlying exposures. Now, there may be different fund share classes in certain circumstances to what I think Bill is referencing, but suffice to say, there is no double charge from Vanguard. And I would argue, again, we are as transparent as any in the industry, from a fee perspective relative to some of the questions that were raised about the TIAA traditional. So no double charging going on there. And again, there is the rebalancing automatically done over time. So I just wanted to clear that air.
Yeah, and that's absolutely correct. There is no double charging. There's no extra layer of fees. It's just that it's just that the retail investor can get a better deal by using Admiral class shares as opposed to the investor class shares. And so, what's it cost? Well, on $1 million portfolio, it's maybe 3 or 4 basis points. So you're talking about $300 or $400 per year. To be perfectly honest, for the average person, that is a convenience cost that's well worth paying.
All right. Questions from the audience?
I have a question. First, I want to just thank everyone for their time. I know how valuable your time is. I was wondering if you could comment on the advantages or disadvantages of taking a chunk of money from 401k, paying that, tax on it for withdrawal and rolling it over into a Roth IRA so that the future gains on that would not be taxed at the time of withdrawal.
Ed, go ahead.
Yeah, maybe over 30 years, you might make 3% of your $1 million in the discounted future value of tax savings. I just published an article in the Journal of Financial Planning this past September. You can take a look at. It's called The Net Present Value of Roth Conversions. It's my third or fourth paper on the topic. And I'll conclude my answer to your question by saying I have not yet found an occasion where Roth conversion makes sense for me.
Thank you.
Any other comments from from our speakers? Otherwise, I invite Jean. Go ahead.
So what do you think about, there are a number of charities that I really believe in, causes I really believe in, and some of them offer very nice interest rates, especially as I get older, by just giving them a chunk of money and getting a guaranteed return. Is this something really foolish to do, or should I make them wait till we die, or what? What's your, how do we deal with that?
Columbia, for example, I think gives
Well, that wasn't high on my list of charities.
7% or something. 7% or something like that on an annuity for people around 75 or 77. Go ahead.
Anyone want to take that, or I'll give it a shot?
Yeah, go ahead, Ed.
All right. So charitable gift annuities, always advertised by all the favorite charities. Okay. And if you're single, you have no heirs that you must take care of, you have the choice. Give the money to the charity now and they'll pay you income, which may be a very, very good deal for you if you're long lived, and they'll celebrate your contributions while you're alive. Or wait till you have passed. The amount is probably larger. They'll be just as grateful to have it then, but you won't be around to get the accolades. There are tax angles, and as everyone else has said today, I am not a tax professional, but it is certainly possible that on an after-tax basis, the charitable gift annuity is an appropriate path for you. And Secure 2.0 liberalized the possibilities for doing a charitable gift annuity straight out of your 403B there.
Right. You can, it's a complicated calculation what your charitable deduction would be when you give that money to the charity in return for the annuity. And it depends on your age and on other factors and whether your spouse is part of it. But you would get an almost immediate charitable deduction. So if you do deduct in your taxes, as opposed to take the standard deduction, you might find that also an attractive benefit.
There's an alternative path, which is something you can do in a rollover IRA that you can't do in a 401k. So you take some of your 401k balance, you put it into a rollover IRA. That's not a taxable event, and then you are entitled to contribute or donate $105,000 per year, which is it's not taxable. And there's another good reason to not Rothifying, which is that God forbid you have long-term care expenses. If they are substantial enough, you get to deduct a significant portion of those as a legitimate medically necessary expense. And so that money, that to the extent that you do that, that money will never ever get taxed. Didn't get taxed when it went in, didn't get taxed while it was accumulated, and it doesn't get taxed when you spend it for long-term care, or at least a significant portion of it for long-term care.
Very nice point. Other questions? Could we perhaps address the issue that Michael raised, but we did not develop it, namely the order in which you want to take money out of your various asset categories or accounts, after taxes, before taxes, etc. Michael, would you like to address this in more detail?
I'll do my best, again, with the hedging language, as this is an individualized decision based on what you believe your current and future tax rates may be. But I'll say, as a general rule of thumb, an investor may consider, right, to the extent they expect their tax bracket to be lower in the future, they may wish to draw from taxable accounts first. Because again, to the extent those might come out as long-term capital gains if you're selling securities to generate that income, if you're liquidating securities, which may be beneficially taxed for investors. Whereas when you pull the money out of the 401k, to the extent it's all pre-tax dollars contributed, that's going to come out as income, right? So that can be a very significant tax bill. And I think, oftentimes investors say, I've saved $1 million in my 401k, which is great, by the way, fantastic. But they don't, or they fail to think about the implications of taxes upon withdrawals, which will take a big bite. And my general thinking is taxes probably are not going down in the future, given the federal budget situation. But suffice to say, I would say at a high level, Ellie, I would say it depends on what you think the trajectory and path of your future taxes could look like. And if they're going to be lower, that might lead you to taxable accounts today. If you think they would be higher in the future, that might lead you to considering withdrawing from tax deferred accounts, the 401k, in the more immediate future. That's a very high level generalization, I'll fully admit.
Ed, Bill, Angela, on that issue?
All
Yes,
right.
go ahead.
If I may. Michael touched on the key uncertainty with all these sequencing decisions. If only I could predict the federal tax structure over the next 30 years. I mean, how hard can that be? Well, pretty darn hard if you look back over the last 30 years. This is what Roth conversions were sold from the beginning, by the way, since the late 1990s, using the exact same language that Michael did. Taxes can only go up from here. Okay, and it's interesting. The Tax Foundation publishes a sinking list of past income tax brackets and rates back to 1913. And you can see that a person who was in the 22% bracket here or actually the 24% bracket here in 2025 would have been in the 28% bracket before 2017 and would have been in the 31% bracket when Roth conversions first became available. That middle class person would have converted at 31% and be taking RMDs at 24%, not kind. So the caution to the audience, it's the caution that Michael made and that all of us have made, taxes make investment look simple, okay? And the uncertainty around future tax rates, what it's going to take for a Roth conversion to pay off today, what it's going to imply that you take income this year from bucket A versus bucket B, just so many unknowns. The positive thought I'll leave you with, and it only applies to the not yet retired. Many of us between about 66, early for professorial retirement, but I managed it at 63. For many of us, if you retire in your mid-60s, you choose to defer Social Security until age 70, you have a temporarily very depressed tax rate. Most of you are in New York. I'm in California. I spent most of my working life paying a 45% marginal tax rate. And just possibly, didn't work out this way for me, my spouse kept working, but just possibly between age 65 and age 70, you have a chance to pull a bunch of money out of your 403B, pay that low rate of taxes on it. You've got a lower RMD in the future. And so there's a sweet spot there. Ellie.
Thank you very much, Ed. Other questions? Yes, Frank, go ahead.
I had a question about something that was said in the presentation that I didn't follow. If I heard you correctly, Ms. Bellamy, I heard you say that you can only annuitize money if you have TIAA traditional, whereas I would have thought that if I were a client of Vanguard or Fidelity or any other institution, I can buy an annuity from them just as well as I can from TIAA. I know you were touting the advantages of the guaranteed return, but I wanted to say I thought that was not quite accurate, or did I misunderstand you?
Nope, you are absolutely correct. There is a larger story there. So I was speaking specifically to TIAA traditional, but you are absolutely right. There are different investments within the portfolio that can be annuitized. So believe me, absolutely, there are other investments. So there's the guaranteed behavior of the TIAA traditional, but we do also have variable investments as well that give you some flexibility in sort of some guardrails, if you will, ones that might have a bit more upside potential, but there's volatility that comes along with that conversation as well. So much like Mike mentioned, there's a place potentially in portfolios where if you're comfortable taking on certain trade-offs for that risk relative to the upside potential, then it could be a good fit as well. So you're absolutely right. So we do have different types of investments and annuitization.
And then I had another question, which is, unlike many of the very sophisticated people on this call, I don't feel competent to manage my own investment portfolio in retirement. And so I have it divided between some I manage and some that TIAA manages. And I know that what happens in any financial institution when you want to get them to help you and manage your money, they'll ask you, well, how much risk are you willing to take? And so I'm a guy who always says, I'm a moderately aggressive risk taker. And my question is a moderately aggressive risk taker who, like me, is 84, going to have a different investment strategy than a moderately aggressive risk taker at age 64 if I'm working with Vanguard or with TIAA or another institution?
So I wouldn't say necessarily between institutions, but each of us, we have our own set of questions, if you will, a risk tolerance questionnaire that we would ask of you. So the outcome of moderately aggressive may not differ that much allocation-wise between the two. But what I would probably beg to say is that what you may deem as being moderately aggressive, once you answer those questions, you might find yourself falling somewhere different on that risk reward scale.
I didn't make my question clear.
Oh, go ahead.
Sorry. As a moderately aggressive investor in TIAA Trust, where I have a portfolio, I know that I'm not allowed to have more than 80% of my assets in equities. And if I do, then they have to be rebalanced. And so my question is that true of every age group, or do you deal with different age groups differently? Maybe that's the question I'm asking.
Sure. The risk tolerance is actually driving that conversation. So that still would be the same if you were 84 or 64. If moderately aggressive was appropriate for you, then you would have the similar allocation to the same person at a different age, but the same risk tolerance. Does that help?
Yeah, thanks.
Yeah, I have a question actually for Ed, and this is a little out of school, but I think I'm entitled to do this since I've gotten to know Ed pretty well over the past couple of years, which is you gave a very sunny presentation of annuities, fixed annuities, but I know that you have some real questions about annuities concerning credit risk, concerning the money illusion and the the high nominal output, and then the risk of inflation as well. And I wondered if you might briefly speak to that, Ed.
Okay, Ellie, I would love to answer that question. It will take about 5 minutes. Do I have your permission to
Okay, take 4.
take 4? All right. I need to share my screen to answer Bill. So here we go. So the first thing to remember is with any annuity, whether it's the variable annuities that Angela just recently addressed or the traditional guaranteed, it's guaranteed for life and only for life. Okay. And the whole payout structure only works as long as half the people who annuitize lose the bet, if you will. You got to have half the people lose if TIAA is going to keep paying out the money for as long as the longest person lives. Now, let me kind of see if I can go over to a second answer. Let's see. Okay. Now, this is a different paper that I recently published, and it's the second part of the answer to Bill here. Take a look at the light blue line there. What you see here is a TIAA annuity with a TIPS hedge, okay? And basically, you can hedge your annuity payments against inflation. I'm hedging.
Could you explain to us the tips, the inflation
Sorry.
protected government bond types things?
Treasury inflation protected securities, government guarantees to augment the principal of your bond by the amount of inflation, whatever that amount of inflation is. And so you have a fixed annuity payment. Typically, you'll have to annuitize 2/3, put 1/3 into a TIPS ladder. Paper gives you a table to explain how. And if you do that, you can get the inflation adjusted value of your starting point out to about age 100. Okay. And so if the inflation vulnerability of annuities is what concerns you, and I believe that's what Bill was pressing at there, there is a hedge possible. You simply have to take less money, probably about 56,000 rather than the 84,000 to start. And then it is possible with this wonderful financial innovation to make yourself whole up to about age 100 through the combination of the TIPS and the annuity. And I think that was my 4 minutes there, Ellie. Back to you.
All right. Thank you. Thank you very much. We are out of time exactly now. It's 3:30. So let me do several things. First, thank our distinguished speakers very much for taking the time and sharing their expertise with us. Thank you very much. I'd like to thank also Abdallah Hassan and Jason Buckweitz for being part of the management of this project here today. So thank you very much for making sure that the trains run on time. I also like to give a shout out to our indefatigable EPIC team negotiating with the university on our health benefits, which are, and you can speak to them and you can share your experience with them. Frank Wolf, you've heard him, Alice Kessler-Harris, Carol Sanger, Peter Strauss, and Michael Filer. They are a kind of our team, and if you can share your experiences with VIA and the whole insurance system with them, that would be great. So I'd like to thank everybody here for participating. I hope it was helpful. It was useful. I hope the questions and somewhat my provocations to the speakers went well and gave us clarity and some information in decisions that are truly complicated, very complex, intellectually and personally, and it is one of the things that keeps us busy and sometimes keeps us awake at night, our financial situation. So thank you very much for sharing your expertise and your time with us.